Hey everyone, my name is Twinkle. I'm going to start a series of UK taxation, and this would be like a mini crash course for ACCA, ATT, and AAT students, where we will be covering the major topics relating to taxation, which have more weightage in the examinations. As we proceed, you can always suggest what topic you want next so that I can come up a video for that. So, how these classes would work is first we will go through the notes that we will be preparing in class along with. Then secondly, we will be once we are done with the handwritten notes, then we will be using Kaplan's study material to understand if any topics are left. Then once you have the understanding of the handwritten notes and Kaplan's material also, then you can always go through the illustrations and test your knowledge questions. And in case you're not able to solve any of the questions, you can always comment in the comment section that which illustration you want me to solve or which test your knowledge question you want me to solve in the next video. I hope that is fine. So, the topic that we are going to start today is property taxation. I recommend making the notes along with, so that when you write you have more knowledge of you have more clarity of what things we are actually doing. So, from where could be the person earning the property income? It could be from letting out the properties. Then, in that same property, the person is living himself, but there is one separate spare room which he has rented out. So, that will be called as rent a room relief, which will be studying later. Then the third type. Now, this is not a commercial building, but it looks like a residential building, which means like holiday accommodations, like Airbnbs we have these days. So that is called as furnished holiday lettings, which is FHLs. And the last one which we will be studying is, which is bit different. It's not rent, but it is income from property itself. So rent is received on a monthly basis or 6 monthly basis or an yearly basis. But when the person is giving the ownership rights of his property to the tenant, which is called as the lessee, then in that case it's not the rental income that you are earning, rather you are earning the premium on the lease of that property. So the another type of property income would be premium on grant of lease. But here in this topic we will be covering only short term lease and not the long term lease, because the logic I'll explain in the next videos, next slides. Now, first of all, there are four sources from where we can earn the property income. One is letting out of the properties, then second is renter room relief, then furnished holiday lettings, and premium on grant of short term lease. Now, when you rent a normal property, it could be a commercial property or it could be a residential property. So, what is the basis of assessment of this taxation? Means when this income will be taxed. See, HMRC wants to make it very clear. HMRC wants to make it very simple and straightforward. Now, people may be letting out properties, but they don't know accounting. So they can't go with that, okay, the income is due now, but it is received after 6 months. The expenditure is due now, but the payment will be made after 2 months. No, the normal public does not know this. So HMRC has come up with a simple solution that property income will be taxed on cash basis, which means the default method is cash basis. Now, what is cash basis? Tax the money when it comes in and deduct the expenses when they are actually deducted. So, money in and money out principle is followed. Now, cash basis is the default method, but if there are some richer landlords. What do you mean by richer landlords? The landlords who are earning property income more than £150,000, so they will be following accrual basis to calculate their property income, right? So in examinations, the default method would always be cash basis unless stated otherwise, or the landlord has property income exceeding £150,000, right? Now, the next topic which we will be studying is what are the expenses deductible from property income. Now you tell me what could be the expenses from property income. Whenever you're having a property, there would be certain insurance amount that you would be paying on that. Then it could be ground rent, it could be repairs and maintenance, it could be gardener's fee because the gardener is coming doing the cleaning and other jobs. Now you have let out a property through a agent, so it could be agent fee, it could be management fee because the agent is taking care of the property. Then sometimes you have to pay tenancy fee as well, and so on. There are so many other expenditures. Now, just remember the golden rule here again: the expenses which are wholly and exclusively for letting out the properties. Wholly and exclusively test has to be checked when we need to see whether these expenses are deductible from property income or not. Now, there is one major expense that the landlords usually incur, and that major expense is the landlords would have taken this property on mortgage. So, the landlords would be paying interest, or which we also call as finance cost, on mortgage. Now, should this be deductible fully? There are special rules behind this. Let's study those. Interest or finance cost on mortgage. It could be a residential property or it could be a commercial property. Now, till 2017, the landlords were following the scheme of buy to let out, which means they were buying the properties only and only for the purpose of letting out and not actually staying in that property. Now, there were higher income taxpayers and additional rate taxpayers who were having huge incomes, so they were investing a lot of amount in the properties, in return paying huge interest income also. So they were getting relief also. Let's say £100,000 is the rental income and 40,000 is the interest on finance cost. Now, for the basic rate taxpayer, he will get only 20% benefit on this 40,000, which means 8,000. Now, but the additional rate taxpayers and higher rate taxpayers, 40%, 45%. On same 40,000, somebody is getting a benefit of 16,000, somebody is getting a benefit of 45%. Now, for the person paying same benefit, for the person paying same interest on mortgage, the benefit was different for all these persons. So in order to synchronize that, everyone should be getting the benefit of the same interest costs that they are paying, HMRC has come up with separate rules so that people are not only buying the properties for the purpose of letting out. So what the rule is, the rule is that 20% of finance cost is treated as relief from tax liability. What does this mean now? This means whether the person is a basic rate taxpayer or the person is a higher rate taxpayer or the person is additional rate taxpayer, everybody would be getting the benefit of 20% of finance cost. So in order to simplify this, what HMRC has done is that first you calculate the property income, which means income less expenses, and to carry out a same treatment for that, when tax liability will be calculated, here you deduct 20% of this finance cost, which means now the treatment will not be here in the expenses, rather the treatment will be here in the tax liability. And this was done to synchronize the treatment for all the taxpayers, whether the taxpayer is a basic rate or a higher rate taxpayer or the additional rate taxpayer. But when it comes to commercial properties, full finance cost is allowed. Full finance cost is allowed as a deduction of expense. Here you don't need to deduct it from the tax liability, rather you will directly deduct it from the income that you have received. Hope this is clear, and the logic behind 20% of the finance cost is also clear, right? Next, so what we have done is letting out properties is done, then basis of assessment is done, then what are the expenses deductible from property income, we have also done that. The next thing that we are going to do is, which is a bit complicated and where people will again try to cram those things, the topic is premium on grant of short term lease. First of all, tell me, what is lease? Lease is when you are not letting out a property for a shorter period of time, rather, you are giving this property for a longer period of time, and this longer period that HMRC considers is 51 years or more. Now, when you are giving the same property to one person for 51 years or more, it is like basically you're giving the ownership rights of this property. So the person who will be letting out this property for 51 years or more to the another person, which means lesser is the landlord and the lessee is the tenant, and it is for the period of 51 years or more. But what if the property is let out for less than 50 years? Generally, rental income would be received on monthly basis or yearly basis or half yearly basis also, because if you would have seen the rental agreements, it is mainly 6 months in advance, 1 month in advance, 3 months in advance, 12 months in advance. So that is basic letting out property. But what if now the agreement is such that the property is provided for 30 years or 40 years? So HMRC says that this is a capital expenditure that the person has incurred on this property. But will rent never be taxable in that case? No, the rent will be taxable. Premium is what you pay here, and short term lease is less than 50 years. So, for the period, and the long term lease is 51 years. Now, out of this, the number of years for which the property is let out on lease will be deducted so that you get a portion of premium which is taxable as property income. Hope the formula is clear. Just note this point, then I'll make it clear with the help of example. Shorter the premium, sorry, shorter the lease period, more portion of premium will be taxable. Longer the lease period, less portion of premium will be taxable. Let's understand this with the help of example. Let's say a premium of £100,000 was paid for a property that was given on lease for just 1 year. The long term lease is more than 50 years, starting from 51 years or more, and total lease period that is considered is 50 years. So here 1 lakh pounds, it's again taxable, which means shorter the lease period, more portion of premium will be taxable. This is, if it is just for 1 year, this is kind of rent only. Rent is taxable, fully taxable, right? Now, again, the premium is 100,000. Short term lease is up to 51 years, long term starts from 51, and now this property is let out for 10 years. So, here the portion that we are taxing is for the 9 years, which means this amount will be less than this 100,000. Again, shorter the period, more portion of premium will be taxable. Longer the period, less portion will be taxable. Let's say this lease was entirely for 50 years. There would hardly be any amount that would be taxable. So HMRC doesn't want to tax the capital receipt, which is a big amount of receipt from property on granting of this lease. Rather, they just want to tax the premium out of this premium paid on this, which will be a kind of rent receipt. So the period of ownership in the lease, first of all, will decide whether it is a short term lease or a long term lease. And once this period of ownership is decided, it will be easy to calculate that how much portion of this premium is actually taxed as rent and how much of this is taxed as the capital receipt. So is this clear? I hope there is no need to cram the formula now. It's premium into 51%, 51 minus 50. Now, the most important topic, which where people will mostly cram, let's try to make it simple. Furnished holiday lettings. This is FHL, which is kind of Airbnbs. Now, this is not a residential property, this is not a commercial property, but this is like a holiday accommodation. Now, if it is a holiday accommodation, which means it's my property, but Someday another tenant is coming, someday another tenant is coming, which means I don't have a single tenant. And when multiple customers are there, is it a business thing? Am I trading, or am I just letting out a residential property? Now when you go to Airbnbs, it's like a house. That house which is fully furnished, you get all the facilities like a home. So is it a business property because more and more tenants are coming day by day, or is it a residential property because it's like a furnished, it gives like a feeling of home? So there is a different tax treatment for furnished holiday lettings. To be able to claim tax treatment for furnished holiday lettings, there are certain conditions, and all of those conditions have to be satisfied. All of the conditions to be satisfied. Once we know that what are these conditions, then I'll tell you the benefits. First of all, for any ordinary person who is going out on a holiday and is booking a Airbnb, that person would expect that this Airbnb is fully furnished. So the first condition is fully furnished. Now, what I will do is I will um I will have one furnished property. I will list it in on Zoopla or Open Rent or any other letting websites. I'll just keep there, and I'll say that this is my furnished holiday lettings. Uh, Now, why I will do this? Because I want to get the benefits of FHLs. First of all, let me tell you what are the benefits so that it is easy for you to understand. FHL benefits. Since here this is a trading, because new customers, new tenants are coming day by day, this is kind of a trade that a person is doing. So we discussed before that in case of commercial properties, 100% of finance cost is allowed. Then we discussed that uh, only revenue expenditures wholly and exclusively for the business are allowed, but here you can claim the benefit of capital expenditures as well, right? So what people will do is people will list their properties on Open Rent or Zoopla or any other letting websites, and then what they will do is they will try to claim the benefits of this. So HMRC says that for you to say that yes, this residential property is let out to various tenants during the year, so I want to claim these benefits, you need to first prove certain conditions that this is a residential property but in the nature of business where different tenants are coming. So first is fully furnished. Now this property should be available for letting out for 210 days in a year. Now what is the logic of 210 days? Means this should be listed on the website for more than 6 months. Next, it's not that you are letting out this property to your friends and family and then you are saying that yes, this is a commercial property, the house that is let out. So people should be able to use this property for a period of 105 days, which means half of this, that it is available listed on the platform for 210 days. Why 210 days also? Because in the UK generally the peak season is in the summers, or it could be anywhere else also. People will what they will try to do is in the peak season for 4 or 5 months they will list out this property, and then they will claim the benefits of FHL, but it is a residential property. So HMRC says that it should be let out for 210 days, it should be available for letting out. Now the tenants are coming and staying here for 105 days minimum, which means half of this. And the last condition is long term occupation. This should not be for a long term occupation. What do we mean by long term occupation? 155 days in total, but more than 31 days. See, somebody who has come on holiday will not stay for a period of 30 days, 1 month, in normal terms. But there may come up certain situations when this person has to stay longer for a period of 31 days. So HMRC says that okay, for 1 month, for more than 1 month will be a long term occupation, but all these long occupations should not exceed 155 days in total. So is this clear? Why 155 days again? 5 months. If one tenant is saying staying in the property for around 6 months, which means he wants to get that property permanently occupied. So 5 months is the period where HMRC says that yes, this will be considered as FHL. So the conditions for FHL will be this property is fully furnished, it's available for letting out for 210 days in a year, people are able to actually use this property for 105 days, and there should not be a long term occupation, which means exceeding 31 days. But this 31 days exceeding can in total be only for 155 days and not for more than that. I hope this is clear. And now, once your property has been recognized as a FHL, then certain benefits can be derived. Though it is a residential setup, but you can claim the benefits of a business setup, which means 100% of the finance cost can be claimed, capital expenditures can be claimed. Clear? Now, there can be a loss also from FHL business. This is kind of a special treatment we are giving here. So, loss from FHL cannot be set off from normal property, but loss of normal property can be set off from FHL. Is it clear? This is just an additional point to note. So three main topics were there in this chapter, which were like bit confusing and where people have to cram. So we have done those topics. Furnished holiday lettings is done, premium on grant of lease is done, and then the 20% finance cost thing is also done. Now, the last topic which we are going to study is rent a room relief. A landlord is having one room in his house vacant and then he wants to let out that simple thing. 7500 relief is available from that property, which means your property income, let's say 17,500, this is per annum relief, less relief, you simply deduct 7,500. You don't need to deduct any expenses here. This could be one way. Or now that you have incurred more expenses than this 7500, what you can do is you can directly calculate the income like this: less expenses, this is your net income, and from here you can deduct the relief, which means when the income exceeds 7500, then you can directly deduct this 7500 relief from here. Now, whether to choose option A or whether to choose option B will depend, whichever is more beneficial. This is very simple, so just creating a short note here. Now, just one thing that is left is replacement of domestic items. What would be included in replacement of domestic items? Now, we discussed before that mostly the revenue expenditures are allowed and not the capital expenditures. But capital expenditures in terms of furnitures and fittings, plant and machinery, etc. But now let's say the landlord has kept washing machine in the house which is semi automatic. Now this machine is no longer beneficial and the landlord has replaced it with a very similar washing machine which is semi automatic. Will that be allowed? Yes, because that is a replacement of the domestic item that was originally available. But if the landlord has brought another machine, let's say it's a fully automatic machine now, then it's not a replacement of the original one, rather, it is a new fitting brought to brought for the purpose of business. So this will not be allowed. And here, if the same one is replaced, then the cost of new one will be allowed as a deduction. Now, somebody is using a car for the purpose of letting out business. How the person will be using that car? The landlord is visiting the property and he's using his car for this property. So, will any expenditure be claimed for this? There are two treatments in case of car. One is the capital allowance, which we will study in the next chapters, and the another is mileage allowance, because this is landlord's personal car, and when it comes to personal car, then the person can claim mileage allowance. How much mileage allowance can be claimed? For 10,000 miles traveled, 45p is what the landlord can claim against each mile, and if it is more than 10,000 miles, then 25p is what the landlord can claim. Now, whether to go for capital allowance or mileage allowance, again, it depends, whichever is more beneficial. Yeah, so that is all for property income. We have covered various topics. Now, these are all the handwritten notes. I'll upload them also. And now, next, we will be going to Kaplan's study material and see if we have covered all the topics. Yes, so here we are with the Kaplan study material, property income, property business profits, lease premiums. We have done types of letting income. Types of letting income would be profits arising from lease or rental of the property, premium on the grant of lease, profits arising from commercial letting of furnished holiday accommodations, and rental income received for renter room relief. We have covered the treatment for all these. Now, next is what is the basis of assessment? Basis of assessment is normally the cash basis, means accounted for when the cash is received and paid, but in certain circumstances, the accrual basis would apply, and that circumstance is when the income is more than the property income is more than 150,000 pounds. Now, if the landlord lets more than one property, then the assessable amount for each year would be the aggregate of net income from all of these properties, except furnished holiday lettings, because I told that there is a separate treatment for that. Now, what is cash basis? The income actually received less expenses actually paid. Yes. So the next is what expenses are allowed or what deductions are allowed against the property income. The golden rule was wholly and exclusively for the purpose of property business. And then the items which were covered were insurance, repairs, interest on loan to acquire or improve a non-residential property, because for residential property there was a 20% relief from the tax liability and not from the actual income paid. Then it could be agent's fee, management fee, etc. Then there are special rules which apply to financing cost of a let residential property. Relief is available for any expenditure. Yes, this point was not covered before. Now, let's say a landlord has not let out the property till now because he was busy in doing certain repairs, or certain other expenditures were being carried out, which means that was a pre trading expenditure. So, if any pre trading expenditure was also covered out, that will also be treated as a expenditure from the property income. Now, there was a certain part of year when the landlord was staying in that property. Will the expenses be allowed? No, because the property was not let out, so the expenses will also not be allowed. If the property is occupied for a part of the year by the owner, any expenses relating to private use are not allowable expenditures. There are special rules which apply to capital expenditures, which we will be studying later. Now, these illustrations, you can go through the illustrations and let me know if you want me to do any illustration for you. Next is financing cost for residential properties. Again, what the simple rule was, 20% deduction from taxpayers' final income tax liability. The tax relief is provided, which means it will not be deducted from the property income as an expense. Rather, 20% relief will be provided from final income tax liability. Let's read this. Tax relief is given on let residential property finance costs at basic rate 20% by deduction from taxpayers' final income tax liability. No part of loan finance cost is allowed as an expense of the property business. I hope this is clear. Again, then there are certain illustrations. Then capital expenditures. Yes. Under the cash basis, there is generally no distinction between capital and revenue expenditure in respect of plant and machinery and equipment for tax purposes. Expenditure on plant and machinery except cars. Because why except for cars? For cars, it could be either capital allowance or it could be um, the mileage allowance. So, capital expenditure on cars is not treated here, but expenditure on plants and machinery will be allowed here. But then we saw that there were certain assets provided in the residential property, like furniture, TV, will not be covered here. The general rule of capital expenditure being deducted will not apply to cars, and then assets provided in residential property like furniture, TV will not be allowed, but replacement of these items will be allowed. Next, Next, for cars, what we did was either it is capital allowance, capital allowances are available on the capital cost of the cars, which we will discuss later, or alternatively, HMRC has provided approved mileage allowances. What are the approved mileage allowances? First 10,000 miles, 45p, over 10,000 miles, it's 25p. Then, next is replacement of domestic items relief. Any assets which are provided mm, in the residential property, the actual cost of those are not allowed, but if you're replacing those domestic items, then you can get a certain relief. So, as stated, expenditure on assets provided for use in residential property, example furniture, TV, is not allowed. In addition, capital allowances are also not available. However, for furnished residential lettings as a special relief, so here they are talking about FHLs, furnished holiday reliefs, replacement of domestic items relief is available. This is not FHLs. This is just for furnished residential lettings. For FHLs, it's covered later. The relief allows a deduction for replacement of domestic items provided by the landlord. So, what is the deduction? What is the amount that has to be deducted? Replacement cost less any proceeds from the disposal of original item. Then again, there is an illustration here which can be covered. Then next is, when will be the accrual basis applied? Accrual basis will be applied when the property income receipts exceed 150,000. Now in exam, the confusion can be created whether the total income of the person exceeds 100 or 50 150,000, or is it just the property income. It's just the property income when it exceeds 150,000, then the accruals method has to be done. But even if it is less than 150,000 and the question specifically specifies to do it, then you have to use the accruals method, otherwise the cash method would be applied. Now, property business losses. If the rental income is less than the allowable expenditure, a loss arises. Landlord owns more than one property. Profit and loss on all properties are aggregated to calculate the assessable incomes, which means profit of one property less loss of another property. But these should be UK properties only. Now, what if one property from where the profit is a UK property, but the another property is a non-UK property, which means it's a foreign property? Then setting off the loss is not allowed. And similarly, we did that profits from UK property and loss from FHLs is also not allowed. The special rules were covered. But let's say the profit was 100,000 and the loss was 120,000. Can I take this 20,000 as a loss and and set it off against another sources of income? No, this is not allowed. Rather, this 20, now the income that will be shown in my statement will be zero, and this 20,000 can be carried forward for unlimited period, because it's again simple that property loss will be set off against property loss only and not for the other incomes that the uh, person is having. Then the next topic was premiums received on the grant of short term lease. Now, what is premium? It is a lump sum payment made by the tenant to the landlord in consideration for granting of lease. The grant of lease is where the owner of the property gives the tenant the exclusive right to use the property for a fixed period of time. But here we will be studying about short term lease. So, short term lease is a period of less than or equal to 50 years. What is the treatment of this? Part of the premium received in respect of granting of short term lease is assessed on the landlord as property income. And we did this formula that premium into when the long term lease starts at 51 years, divide by short term lease period is total 50 years less any amount, any years, which is n. So premium, short term lease is total for 50 years, long term lease starts from 51, and the number of years for which this property is let out. This amount will be taxable as property income. Now, the last topic, which is furnished holiday lettings. Furnished holiday lettings, we have various conditions. First of all, cash basis is the default method for this scheme. Then the qualifying conditions are property should be furnished, because any reasonable person coming on a holiday would expect that the property is furnished. Then it is let out on commercial basis with a view to realize the profits. Then available for letting for 210 days, which means a 7 months condition has to be followed. Accommodation is actually let out. It means it's not only registered on the letting websites, but it is actually let out also for 105 days. And then long term occupation, which is 31 days consecutively when the property is let out to same person, but the total must not exceed 155 days. Now, what is the tax treatment? Since it is treated as a business property, so the profits are relevant as relevant earnings for the purpose of tax relief. Finance costs are fully deductible. Plant and machinery, including furnitures and fixtures, are allowed. Then, under both cash and accrual basis, the deductions apply instead of replacement of domestic items relief, which means full cost can be deducted and it's not only about replacement. The last topic is rent a room relief, when one room out of the property is let out and the landlord is also living in the same property. The cash basis is the default method and should be used in the examination unless specified. Gross annual receipts are £7,500 or less. Income is exempt from tax, because let's say the property income itself is 7,500 and then you're claiming a relief of 7,500, then this income is exempt from tax. But if there are joint owners, then this 7500 limit would be 3750 3750. Joint owners, it could be like between the spouses or um, any other two joint owners. Now, gross annual receipts are more than 7500 pounds. You can do the normal treatment. Income received less expenses will be the profit, or rent a room relief directly. Use the income received, no need to deduct expenses, rather you can do this thing. A rent a room relief election must be made within 1 year of 31st January following the end of tax year, which means at the time till the time of filing the self assessment return. Yes, so this was about the property income chapter. The summary again: types of income, property business profits, FHLs, rent a room relief, then lease premium, where we did this calculation because it's easy to understand, then basis of assessment, cash basis is the default method, accrual basis when 150,000 exceeds or when specified in the question, allowable expenses wholly and exclusively for business, and then pool profits and losses, which means where we discussed about set off of losses against the property income and where this set off is not allowed. So this was all about property income chapter. Now you can go through the illustrations and test your knowledge questions, and if any illustration is not clear, then we can do it in the next video. Thank you.